Can the Fed print money? On today's show, we're going to take a behind-the-scenes look at the commercial banking system to find out what the Fed is really doing. I'm your host, Steven Van Metre, and thanks for joining me for this special edition of the show, where we're going to go through step by step of what the Fed does when they engage in quantitative easing or large-scale asset purchases, and we're going to address some of the major misconceptions surrounding quantitative easing, such as, does the Fed print money? Do these reserve assets leak out into the economy? Does it cause stock prices and home prices to go up? Is the Fed trying to devalue the dollar and make interest rates rise? Well, when we're done, I'll let you be the judge. Now, today's presentation was adapted from a conference that I attended and spoke at in Las Vegas in early 2021. So let's get started. And the first question is, can the Fed print money? Well, many believe they can, but in actuality, the Fed can't print money at all. Jerome Powell, on a 60 Minutes interview, did say, quote, as a central bank, we have the ability to create money. So you start to understand where this misconception comes from. Well, it starts with the Fed itself. But did he really mean that? Well, let's keep going. He said that the Fed can create money, and they do that digitally by buying treasury securities or other government guaranteed securities that actually increases the money supply. And that's where we get this confusion is, if the Fed is buying something and that causes the money supply to go up, well, then certainly it must be money printing. But it isn't. Let's keep going. During the Q&A following the FOMC press conference, Powell was asked by Steve Leisman of CNBC if the Fed prints money. And Powell said, quote, we are simply changing the nature of a reserve. So let's look at what a bank reserve is and how it's created, because that's the first step of trying to understand what the Fed is actually doing. Now, when a customer deposits cash into the commercial banking system, this is where things begin. And I want you to understand, when I talk about the commercial banking system, the three most common commercial banks that people are familiar with will be Bank of America, JP Morgan Chase, and Wells Fargo. So if you have or you know someone who has an account at one of those banks, they are considered commercial banks, and this is where quantitative easing starts to happen. So when new cash enters a commercial banking system, now what does that mean? Well, that can be cash that comes from outside the commercial banking system, from maybe a local bank or from overseas that are dollars coming back into the U.S. But the most common way we see new cash enter the banking system is when a commercial bank originates a loan. So if you borrow money from a commercial bank and immediately deposit it in your account, well, that's new money entering the commercial banking system. And this is what actually happens behind the scenes. So what you see here is that a customer will deposit cash into the commercial banking system, into their account, and the customer will have this as an asset on their balance sheet. And that is very important to understand. Now, the bank, you see here, commercial bank, that cash deposit is a liability to them. Now, if you're wondering why it's a liability to the commercial bank, it's simple. Well, what if you went down and withdrew your money from the bank? They have to have it. They have to pay you, so it's a liability to them. But as a business, having a large amount of liabilities is never a good thing. So the commercial bank wants to get rid of that liability. More importantly, it wants to turn it into an asset. And let me show you how they do that. So the next step that happens is the process of creating an actual bank reserve. What the commercial bank does is it transfers that liability to the U.S. Treasury by purchasing a Treasury security. Now, this is very important to understand that the commercial bank takes customer deposits. Doesn't matter if it's commercial or consumer, takes customer deposits. So again, if you have an account at Bank of America, JP Morgan Chase, or Wells Fargo, this is what's happening behind the scenes. They're taking your money and they're buying treasury securities. So if you say, I really don't like U.S. government debt, well, if you have a deposit at a commercial bank, your money's backed by the U.S. government. So that's the first step. And what happens here is the commercial bank takes a customer deposit and purchases a treasury security. And what they're doing is transferring that liability of the customer's deposit to the U.S. Treasury. So the U.S. Treasury security is considered an asset. So on the bank's balance sheet, they now hold an asset. The customer's cash deposit, well, that's still an asset to them. And the U.S. Treasury, the government, has a liability. And that is the process of creating what's called a bank reserve. Now, what's interesting about this from the customer perspective, they don't know this is happening at all. There's nothing that would indicate at all that this is happening. One thing they do know is they get paid interest on their deposit. Well, the bank doesn't have interest to pay them just with the money sitting there, but the interest they generate off of the U.S. Treasury security is used to pay the customer deposit, and that's how it works. So the first step in this whole process, before we even get to quantitative easing, is the creation of a bank reserve, which again comes from a customer deposit. Regardless if it's a consumer or a commercial deposit, any deposit in a commercial banking system is then transferred to the U.S. government. So the bank has an asset, the U.S. government has a liability, and the customer is unknowing of this entire process the whole time, and they still have an asset. When they log into their account or get their statement, it shows what's money is good. All right, let's go to the next step now to try to understand what Powell actually meant. Because if we try to relook at what he said in that press conference, what he was actually saying is we're simply changing the duration. Now, he said the nature, so we'll say nature being the duration of a bank reserve. That's what quantitative easing really does. It's what it's really designed to do. Now, according to the U.S. Treasury, deposits stay in the bank for approximately 3 to 7 years, depending on if it's a retail or consumer deposit or a commercial deposit. So it's important to understand that when money is deposited into the banking system, it doesn't immediately leave. It's there for a while, and that's what allows the commercial banks to go out and buy Treasury securities to generate the interest because they know the money is going to be there for a while. Let's keep going. So the average is about 5 years that a deposit will stay on the balance sheet. So commercial banks are purchasing Treasury bills and notes, so their balance sheet has an average duration of about 5 years. Makes perfect sense. And so what quantitative easing is just a reserve swap. That's all it is. It is nothing more than that. And so what happens is the Fed will purchase a bank reserve. And again, just to clarify what a bank reserve, it's a customer deposit that has been used to buy Treasury security. So again, I want you to keep in mind this whole time through that reserve, that bank reserve, that Treasury security the Fed is buying is tied specifically to customer deposits. That's very important to understand and how this works. So let's continue on. And then what they do is they swap it with an overnight reserve or reserve assets. From a bank's perspective, their balance sheet is unchanged. So let's take a look at what's happening now. Because in the slide before, the customer deposit was backed by the U.S. Treasury. That's going to change a little bit now. So the Fed is going out and purchasing a Treasury security from the commercial bank in exchange for a reserve asset. Now, the reserve asset is being created by the Fed, which is where we get the money printing notion from, but it's not that way at all, which I will explain shortly. So that bank reserve or Treasury security is an asset to the bank and swap with a reserve asset, also an asset to the bank. So you notice from the commercial bank, they still have an asset. The customer deposit, you should notice now, is being shifted to what it's being backed by. This is important. The liability of the U.S. government or the Treasury securities are then transferred over to the Fed's balance sheet. So that's where they're sitting. The Fed is the new owner of the Treasury security and collects the dividend from the securities it owns. So the federal government pays the Federal Reserve the interest on those Treasury securities. The Fed pays the banks currently 0.15% or 15 basis points on the reserve assets, which then is turned used to pay customers the interest on their deposits. All the Fed did was move that Treasury security to their balance sheet and replace it with a reserve asset. And in the process, they changed the nature or duration of a bank reserve. No money was actually printed. The bank still has an asset on its balance sheet, but that asset can only be converted to cash when the Fed engages in quantitative tightening. The customer's deposit, which is key now, remember the customer deposit was originally backed by a Treasury security. The only difference now that I want you to understand is it's backed by the Fed. That's it. That's all that happened. So your deposit at Bank of America, JP Morgan Chase, or Wells Fargo that was backed by a Treasury security is now backed by the Fed. That's all that happened. Nothing else happens. That is it. And from a consumer perspective, from a commercial, from a business perspective, you don't see this at all. It's completely transparent. You don't know if your deposit is in cash, if it is being backed by Treasury security, or if it's being backed by the Fed. You have no idea. And that's by design. So the first thing I want you to understand is customer deposits are tied to bank reserves by the purchase of Treasury securities, which are then swapped by the Fed for a reserve asset. So the customer deposit, this is a very key thing to understand, is tied to that reserve asset, which is owned by the Fed. That's important. So that customer deposit is entirely backed by the Fed. All right, let's keep going on. So if we look at the Fed's balance sheet now, what we see is the securities on the Fed balance sheet are right here. You'll see this is the most recent one, is a December 2nd. U.S. Treasury securities, you see total of 5.5 trillion, 5.582 trillion, and then you see mortgage-backed securities at 2.576 trillion, and you can see it's broken down between bills, notes, and bonds, inflation index, and whatnot that the Fed owns. Now, the reason people assume this is money printing is because they don't understand this very key concept. What you see on the Fed's balance sheet is removed from the financial system. Those securities don't trade anymore. Those Treasury securities, those mortgage-backed securities, they're not that you can't buy them, you can't sell them from the Fed. They literally are removed from the financial system. Now they're accounted for on the Fed's balance sheet, and this is important because the government still has to pay interest on, and those securities still mature. That all still happens. But from the financial system's perspective, they're removed. And so if the Fed is removing something from the financial system, it has to replace something of equal value, which are the reserve assets. So when people say the Fed's printing money, they see that reserve asset being created, but they don't realize those Treasury securities are actually, and mortgage-backed securities are being removed from the financial system. And that's really important to understand. This is a net neutral transaction. There's nothing going on to even gives you the hint that there's money printing when you realize that the Fed's balance sheet is off limits. All right, let's keep going here, because these reserve assets have an overnight duration. So remember, we're talking about those Treasury securities having an average duration of 5 years. Well, these have an overnight duration. So they mature every night. So they're just, and that's what cash is. If you look at what the dollar is effectively an overnight duration Treasury security. So the Fed is taking Treasury bills, notes, and bonds, whatever it's purchasing from the banks of an average duration of 5 years, removing those and replacing it with dollars, which are effectively an overnight duration. But because there's a swap and the Treasury securities are being removed from the financial system and dollars are coming in, it's net neutral to the banks, net neutral to the financial system. Again, no money being printed whatsoever. All right, let's keep going, because all quantitative easing is just a shell game. And the question you should be asking is, why is the Fed doing this? Well, one of the reasons is to prevent the banks from selling Treasury securities. So when we look at the purpose of quantitative easing is to suppress and lower rates, and depending on the size and scope of the asset purchases, designed to actually strengthen the dollar. So we see quantitative easing traps dollars inside the commercial banking system of what I call a dollar prison. These reserve assets are held at Federal Reserve member banks in the name of the commercial bank who owns them. They can be used to settle intrabank transfers, but they cannot leave the commercial banking system. This is very important to understand. It is important because the customer deposits are tied to these overnight reserve assets. So the whole notion when people say, well, I think these reserve assets are leaking from the system, this would imply that my money, which is being backed by those reserve assets, are actually in two places at once. So if they leak out and get into your account, that means you and I are sharing the same money. That's not possible. And that's what's important to understand here. It is not possible for any leakage to occur because it's tied to customer deposited money. So unless that customer deposited money is being broadly shared by multiple people simultaneously, which it is not money printing. And so these reserve assets are held at the Federal Reserve member banks, and the commercial banks account for them on their balance sheet. They cannot be released unless the Fed chooses to. The banks cannot forcibly go out and get rid of them. They can swap them between each other, but they can't get rid of them. So they're stuck in the financial system, again, tied to customer deposited money. All right, let's keep going here, because now what you see is the velocity of money, or number of times money moves from one entity to another, falls as long as the monetary base, here shown inverted, grows. And why is that? Because the total amount of currency that is either, what is the monetary base? Is the total amount of currency that is either in general circulation in the hands of the public or in the form of commercial bank deposits, keyword, commercial bank deposits, customer bank deposits held in the Federal Reserve. That would be those reserve assets. That is shown inverted here. So as the Fed does more quantitative easing, what it's doing is slowing the speed of money. And when you slow the speed of money, it's not inflationary. In fact, that's the exact opposite of inflationary. They're deliberately trying to slow it down. And part of that reason is they're trying to make the dollars that are outside moving around more valuable, because they're taking the dollars inside the commercial banking system and they're locking them in prison. And so it starts to make sense is the Fed isn't trying to weaken the dollar, they're actually trying to strengthen it. And you can see here by the relationship between the velocity of money and the monetary base inverted, and now you're understanding of what's going on, of why you see deflationary effects from quantitative easing, and you see the dollar eventually strengthen. And here is the monetary base shown against the US dollar. And what you note is that the dollar, while it does not follow the monetary base perfectly, does rise over time. And that is why more likely the dollar is going to head higher, contrary to popular belief, than it's going to head lower, because all of this money is being trapped inside the commercial banking system. And even if the Fed were to end its purchases, that money is still trapped there. And there's really only 3 banks it's really moving through. And Wells Fargo can't, due to the current penalties, can't really expand. So really, most of the money is moving between Bank of America and JP Morgan Chase. That's where you get the deflationary effects. That's why you're going to see the dollar with a high probability move go higher. This all starts to make sense when you understand what the Fed is really doing. All right, let's keep going here, because the other thing the Fed is trying to do is lower interest rates, and they're doing that specifically to help money creation. And how do they do that? Is, well, they go out and they buy massive amounts of Treasury securities and mortgage-backed securities. Now, this is the old purchase schedule, which we can see here. But what they're doing is buying massive amounts of securities and replacing them with overnight duration. The whole purpose to lower interest rates. So if the Fed can't print money, well, then what is actually going on here is they're just simply trying to lower interest rates and increase the value of the dollar. But remember, Fed Chair Powell said, and that when he was referring to quantitative easing, actually increases the money supply. So did the Fed really print money or not? Well, let's take a look at the money supply. And here I've brought the history from 1960 all the way to current. But in 2008 is when we started doing quantitative easing 1, then we did 2 and 3, and then we could see the current QE program just shooting vertical here. So what's really going on? Because the money supply, again, is the checking, savings, and money market mutual funds, which gives you the notion that somehow the Fed is printing money. So how and why is the money supply rising if the Fed isn't printing money? Well, great question. There are no alternatives for savers, and that is the key here. Due to compression in yields, there are no alternatives for savers as they seek to earn the highest yield on their savings. But when rates are very low, they choose to hold their money in cash rather than tie it up for a negligible higher rate. And so as you can see, as long as the Fed is engaging in quantitative easing, and the longer the Fed engages in it, short-term yields remain low, and long-term yields are likely to continue falling, along with the dollar heading higher. And here you can see the monetary base shown inverted versus 4-week Treasury yields. So now you start to get an idea that those overnight duration assets are designed to push short-term rates down. And sure enough, you can see as the monetary base rises, shown inverted, short 4-week Treasury bills go down, stay low. As the Fed pauses quantitative easing and then does some quantitative tightening here, you'll notice short-term yields rose, and as they came back, they collapsed back down to zero. And you can also see the same effect in long-term treasury yields, looking at the 30-year, that again shown in monetary base, shown inverted, that every time yields go up, what happens, they get rejected, and the popular belief now is that yields are going to go higher, but in reality, they're actually going lower. And so when we start to look at what's going on, can the Fed print money? No, they can't. They don't have any tools or mechanisms. Quantitative easing was never designed to do that. Do these reserve assets leak out into the financial system? Nope, they sure don't. Is there any part of changing the duration of a bank reserve that would cause stocks to go up for some reason? No, not at all. How about home prices? No, not at all. Because that would also suggest that if the Fed was to do quantitative tightening and then increase the duration of the bank's reserves, that somehow that would have a negative impact on homes and stock prices. And it doesn't make any sense that happens at all. What is actually happening is, due to the suppression of rates, people are borrowing money and using it to buy stocks when you look at the expansion of margin debt, and to buy homes because rates are low. Now that's what it is intended to do. Now, is quantitative easing inflationary? Well, it's only inflationary if rates are low enough to spur lending growth. Otherwise, as you can see, it's actually designed to be disinflationary or deflationary, as it locks dollars up in the commercial banking system. So the Fed isn't trying to devalue the dollar, they're trying to increase the value of the dollar. And if you start to understand why, as a global reserve currency, the United States needs to export dollars. Well, if the dollar weakens, then it spurs domestic production. But if the dollar strengthens and rates get lower, then consumers and businesses will borrow money and buy foreign produced goods and services that are cheaper and export those dollars. That's what the Fed's really trying to do. They're trying to kickstart the global economy by getting dollars to start moving through the system. So now that you understand what the Fed's really doing, you'll know that no, not printing money, reserve assets aren't leaking, and that why, as you've heard me say, quantitative easing is deflationary until it's inflationary, and all that means is rates have to go low enough to spur enough lending growth to create enough new money to actually create the inflation. And now you might also understand why the more the Fed does with QE, rates tend to go lower and the dollar tends to go higher. And with that, again, thanks for being fans. Thanks for watching this special edition show, and I'll see you back real soon. I'm Steve Van Metre. Bye now. The content of this presentation is provided as educational information only. It's not intended to provide investor advice. This material is not to be construed as a recommendation or solicitation by or selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steve Van Metre in personal capacity and does not reflect the view of Atlas Financial Advisors, Inc. or Steven Van Metre Financial.